In this video, we will be discussing the considerations when choosing a broker for CFD trading or Forex trading more generally. This video is sponsored by Prosperity Algo and our free Golden Time Bomb Expert Advisor. Do you want to make 100+% annual returns through automating the London breakout and the opening range breakout? Then click the link in the description. So we're going to start off with some company information to consider, as well as the trading conditions. And really, I wanted to make this video because a lot of our clients have been asking me this, and like, what broker should I use? What conditions are like ideal? And in particular for algo trading, the conditions are so incredibly important for a few reasons, but namely, if you're always executing the same strategy, the conditions around that strategy will make a huge impact on win rate and risk reward. So really bad trading conditions can take an excellent strategy and make it unprofitable. So it's really important here. And it's not just like kind of nice, it's critically important. Moreover, if you're running any sort of scalping system, all of these conditions have a far larger impact than if you were, for instance, swing trading, because like your spread becomes a much higher percentage of your take profit if you're scalping than if you're trying to capture large moves. Same thing with your commissions. If you're obviously trading a high lot size for a small take profit, your commission is a larger percent than if you were trading the same lot size with a much larger take profit. So this is critically important. Moving to the first kind of section, I wanted to discuss like the regulatory regimes behind different brokers. So people will ask like, hey, is my broker regulated, etc., etc. However, you have to understand that there's a bunch of different regulating bodies, and there's different degrees of legitimacy with the different regulators. So obviously this is a personal decision and you would have to come up with your own risk preferences here. But I would encourage you to look up almost a hierarchy of regulators, whereas obviously like the big like large Western country regulators tend to be the most stringent. So think like ASIC or FCA are the two most common you'll see with brokers, as the industry is really based in Australia, New Zealand, and in the UK. But obviously like American or Canadian or Swiss regulated brokers will also have extremely stringent regulation, capital requirements, likely some degree of protection and insurance over the account. So that would almost be the gold standard in terms of regulatory regime. However, that sometimes comes with drawbacks, including like a lack of leverage, or oftentimes the additional regulatory costs will be included in as part of your trading commissions or as part of your trading conditions. Like, for instance, I'm Canadian. If you look at the spreads of any Canadian regulated broker, they're absolutely horrific because they need to recoup their cost of actually running a broker here relative to running one in a more of an offshore jurisdiction. But then moving on to more like offshore jurisdictions, where I'd say the vast majority of Forex brokers are based, there's also like not all offshore jurisdictions are created equally. Some offshore jurisdictions, the most popular one is St. Vincent and the Grenadines, but Nevis, Belize, all of these are pretty popular too, but like particularly Nevis and St. Vincent, there's absolutely zero regulation. Like I can open a shell corporation and start a broker tomorrow. And you have to understand that if you trade with a broker there is literally zero regulation on your account. So you really have to trust the company because there's very few third bodies which can intervene. But then you kind of go up the hierarchy from St. Vincent, which would probably be the easiest possible place to open a broker. You go up to Belize, where there's some degree of regulation, but it's also relatively light. And then you gradually kind of progress up the pyramid, where you'll see jurisdictions like Vanuatu or the Bahamas or Barbados, all of which have a regulatory regime as well, but it's not quite as stringent. And then perhaps one level up, you'll start seeing South Africa, the Comoros, Mauritius is up there too, and that's getting a little bit more legitimate. And then you finally get to like the nearshore brokers, which are pretty solid and actually are quite well regulated. And you'll start to see places like Cyprus, which is an EU country, or Malaysia. They have, I think it's Labuan. Labuan in Malaysia would be one step up, which provide brokerage licenses, but they have a little bit of actual regulation there, so there's a bit more security. So I'd say kind of that tier of offshore, but still relatively legitimate, would be like the Bahamas, Cyprus, as well as more like Malaysia, Labuan territories. And really, so there's a bunch of, like, the whole gradient. That's effectively my point here. And you have to decide which one you think is best suited to you. And moving on here now, I'd also look at the solvency of the company. There's a lot of brokers out there, and some of them are very much just like five guys who set up a shell corporation and white labeled the software, whereas some other ones are true large like institutions that have people with Harvard MBAs running it. So what I would encourage you to do is check out the LinkedIn of the company. If there's 5 employees and there's no like actual legitimate presence, it might not be the best place that you want to put your money. However, if you start to see that, hey, there's like a pretty significant company here, maybe they're a more legitimate company. But once again, fully up to you, your discretion, but that's something I typically like to do. Moving on from the actual like how to pick a broker in terms of company to the actual conditions offered. Really, with brokers, the two things that most people pay attention to are commissions and spreads, rightfully so. I'll touch on both of those, but I'll also discuss on execution, which is something which I find is very overlooked. So commissions, as the name was just, like most brokers, like the industry standard is $7 per lot commissions round trip. So buying and selling, you'll pay that $7. Some brokers offer lower. However, I would be very careful about looking at the conditions if you get a cheaper broker. So that is one thing to keep in mind. $7 is standard. Some offer lower. Some offer zero commission with a slightly higher spread. So just always look at this and factor it in when you run a back test. Spreads is probably the most important thing when evaluating a broker. So effectively, you need to pay the spread if you want to win a trade. So let's say we are entering a long position. Let's take the example here. You would enter a long at the ask. So you buy at the ask, but you need to sell at the bid. So let's say we're buying, my mouse works, here we go. We're buying here and we're trying to hit a 0.5% profit target. In order for 0.05% profit target. In order for price to actually hit, it needs to go up by 0.05% and the spread. So if your spread is 0.01%, it needs to go up not by 0.05, but by 0.06 for you to make 0.05. So if your spread is a significant percentage of your take profit, it massively changes your risk reward, because all of a sudden it means that, like, in order for you to win, you need to actually go up quite a bit more than what you initially planned. And this will have an impact on your risk reward of your systems, especially over a large enough sample size. It doesn't seem like a huge amount of trades, a huge difference, but it makes a huge difference. So let's say, for instance, that here the midpoint went up by 0.05%, but the bid did not, and then it reversed and hit your stop loss. Technically, you would be in a losing trade, despite the fact that, in theory, had there not been a spread, you would have taken profit. So this is so important. And what you can do to reduce this impact is just try and get the lowest spread possible, particularly with scalping systems. So that's why I always encourage clients, like, spreads are so important. Always try and get a very, very low one. Moving on here to the last point, which I find is often overlooked, it's execution. So brokers act really as there's two different types, but the big ones are mostly hybrids. There are B-book brokers and A-book brokers. A B-book broker is a market maker. So a market maker, both, like, you trade with them, so they take your trades, but they're also the counterparty. So they will execute, like, they will be the person on the other side of your trade. So if you buy, the person selling to you is your broker. Whereas a book broker, also known as like a straight through processing broker, STP, they would, in theory, route your order to a liquidity provider, which is some sort of other financial entity, oftentimes a bank or somebody in the money markets or a high frequency shop, who wants to take the other side of your trades. So B-book, they trade against you, A-book in the market. And a great way to look at this is if you ever open a DarwinX account, look at those spreads. They're extremely, extremely jumpy. Like, they're constantly fluctuating every millisecond. It's because DarwinX is a true A-book broker, and they pass all of your orders to the market. So because of that, they're constantly getting different quotes from liquidity providers, and the actual spreads are fluctuating all the time. However, if you look at most brokers are either full B-book or part B-book, and their spreads are a lot more constant. So you will see a lot cleaner spreads. It won't fluctuate nearly as much. And really here, the key takeaway is that there's pros and cons to both. With B-book, inherently, there is a bit of a conflict of interest because your broker is trading against you. However, in A-book, you can have very, very choppy spreads. So here, you just once again have to use your discretion. And what I think is smart is if you're trading with a legitimate company, most big ones do some sort of hybrid model where they do use liquidity providers, but they also take the opposite side of your trades. They do this to be able to ensure like better execution, speed. You can see this little blippet from IC Markets where it says, we offer ECN pricing. We source our pricing from external unrelated liquidity providers. These prices are passed on to you with no dealing desk intervention. So great, they're A-book partially. However, they also say, in order to provide you with better price certainty and to ensure fast execution speed, we do not offset each and every position with our liquidity providers. So that means, hey, we're also B-booking some trades because we're not offsetting them, we're doing them in-house. And 8cap does this, like Pepperstone does this, all the big ones do this. And this would enable you to have a lot cleaner spread. You don't have that same choppiness. And particularly if you're trading during high impact news events or during more volatile events, this can actually be super helpful. So I rambled a bit, but the takeaways from this slide is look for a good company. Most likely they will do a combination of A-book and B-book. That can actually be beneficial to you. But also just be careful, watch out for manipulation. If your spreads are constantly widening, if you're using a bad broker, they might play with this to kind of increase your chances of losses. But really, if you use a good company, this shouldn't be too much of an issue. Key takeaways: low spreads. Please get the broker with the lowest spreads. This is so important. In terms of A-book versus B-book, I would just trade with it, or you can trade with whoever you want, but I personally trade with a large, reputable big broker because they, generally speaking, have more stable spreads because they use a hybrid B-book, A-book approach. So guys, hope this video was helpful. Drop me a comment and take care.